Good morning, class. I'm glad to be with you again on Chapter 4. Before we get started this morning, I do want to tell you that Chapter 4 does not really have a lot of new conceptual information. As a matter of fact, it's just very much of a nuts and bolts, just things that we have to do as accountants. We have to close out, at the end of the year, we have to close out all the revenue and expense accounts, get them to zero to start the next year. We have to close out withdrawals to the capital account. Here's what's interesting. These are not new concepts to you, because for several chapters now, you have been creating financial statements from a trial balance. And when you do that, as you know, we always start with the income statement. Then when you found the net income number, you roll that into the statement of owner's equity. In the statement of owner's equity, you start with beginning owner's equity, you add net income, you add any new investment the owner's made, you subtract any withdrawals, and you get a new ending balance for owner equity, and then you do the balance sheet. And the balance sheet balances when you use that new ending balance that you found. So you've already been doing the conceptual part of what we need to do with net income and withdrawals. All we got to do now is physically make the journal entries so that the general ledger is a clean slate to start the next period. Remember that balance sheet accounts are permanent. A balance sheet shows you where you are at any moment in time. How much cash do you have right now? How much money do you owe people right now? The income statement, the revenue and expense accounts, are an accumulation across time of the activity that's happened over a period of time. And by convention, we use a year to create financial statements. And so we have to start over at zero for the new year. So at this time, I would like to work through some problems. Let's start with SE3. SE3 says, assume that at the end of the accounting period, there are credit balances of $3,400 in patient services revenue and $1,800 in laboratory fees revenue. Prepare the required closing entry. The accounting period ends December 31st. Okay, well, revenue accounts have normal credit balances, so I am going to debit the revenue account to close them out. So I am going to debit patient services revenue. This is Chapter 4, SE3. I'm going to debit patient services revenue for $3,400. I am going to debit laboratory fees revenue for $1,800. And what am I going to credit? I am going to credit the income summary account. The income summary account is a very, very temporary account that we only just use to collect up closing out revenues and closing out expenses. And you will see that the balance in the income summary account is net income. And then we will close out the income summary to the capital account. In a way, it's a wasted step, because you could just close revenues and expenses straight out. You could just close them directly to the capital account. You could increase capital for all the revenues. You could decrease capital for all the expenses. Debit capital, credit expenses. The income summary gives us the ability to make sure that we've included everything. Okay? So this is my general ledger account here. And let's see, looks like $5,200. Okay, so I'm going to go ahead and post this so we can track and see how we're doing. an income summary. Okay, moving on to SE4. Assume that debit balances at the end of the accounting period are rent expense for $1,400, wages expense for $1,100, and $500 in other expenses. So we're going to close these. Now, we are going to debit the income summary. And I'm going to leave this blank for a minute because I'm going to collect up all these expenses. I'm not going to do the income summary in between each one. You can do it either way. It would be just fine. So because expenses have normal debit balances, I'm going to credit each expense account to 0 to make it be 0 to start the new year. These are closing entries, okay? So I am going to credit rent expense for $1,400. I am going to credit wages expense for $1,100, and I'm going to credit other expenses for $500. Okay, so these appear to add up to $3,000. Yeah. Now I'm going to post that debit to the income summary. Okay. Now you're going to see in SE5 it says, well, suppose the credit in the income summary that the total revenues were $5,200 and the total expenses were $3,000. Well, yeah, that's what we got, thankfully. Now we're going to close this out to the P-Meta capital account. Okay, so as you can see right now, as a subtotal, we're sitting on a $2,200 credit in the income summary account. See, credit of $5,200, net the debit against it. You've got a credit balance of $2,200. Well, guess what? The income summary must be zeroed out as well, and that's how we get net income to the capital account. So I'm going to debit the income summary for the $2,200, and I'm going to credit the capital account. Okay, so we're zeroed out and ready to start the next year. Now, SE6 tells us, assume that the withdrawals during the accounting period were $800. Prepare the journal entry to close the P-Meta withdrawals account. Okay, so remember that the withdrawals account is actually an equity account, but it is also a temporary account. It will never show on the financial statements. Okay? So what happens is if I'm the owner and I want to take money out of the business, I'm going to debit the P-Meta withdrawal account and credit cash. So that withdrawal account has a debit balance in it, which means it's a contra account to the equity, right? Because it's the opposite direction of the normal balance in equity. So I am going to debit the P-Meta account to reduce it by withdrawals. Because remember, when an owner takes withdrawals, they are withdrawing from what they already own. They are withdrawing from what they own. They own the company. They own that capital. They are withdrawing from it. So when they withdraw, they reduce the capital in the company every time they take money out of it. Okay, so these are all the closing entries we're going to make. You may remember from my initial written lecture that I told you that we are not going to do reversing entries. Okay, so We're not going to do reversing entries. All right, let's do SE7. I'm going to do it over here because it requires me to do a T account to collect up everything that's happened in the P Meta capital account. It's said to assume that the beginning balance was $1,300. Beginning balance, $1,300. Credit balance in the capital account. It's said to show the effect of all the closing entries. Okay? Well, we increased the capital by net income, which we took away from the income summary. And then we decreased the capital account by the withdrawal, by closing out the withdrawal account to the capital account. Okay? So where are we now on ending capital? 1,300 plus 2,200 would be 3,500 minus 800. I believe, check my math, I believe that's 2,700 for an ending balance for the capital account. Okay, so I'm going to stop this video and then we will move on to E1A.